Welcome to this explainer. Today, we're diving straight into the massive AI hardware boom to explain the core differences between two incredibly popular, yet fundamentally completely different ETF bets, the SMH and the DRAM. We are right in the middle of a generational shift in technology. And if you want to understand how the market is actually pricing the AI revolution, you've really got to look under the hood of the semiconductor industry. So today, we're going to compare a battle-tested, broad market semiconductor fund against a brand new, hyper-targeted fund that's trying to capitalize on the exact bottleneck of the entire AI supply chain.
Here's our roadmap for today. We'll start with the AI Hardware Shockwave, move into our two bets, SMH versus DRAM, then look inside the SMH ETF, jump inside the DRAM ETF, weigh the performance and hidden risks, and finally, wrap up with positioning your portfolio. Let's get to it.
All right, kicking things off with Section 1, the AI Hardware Shockwave.
Take a look at this number on the screen, 130%. Research from Gartner is actually predicting that by the end of 2026, the combined price of DRAM, that's dynamic random access memory, and solid-state drives is going to surge by a staggering 130%. You guys, this isn't just some minor blip. We are talking about a massive structural shift in the raw material cost of modern technology.
So obviously, this brings up a huge question. Why are hardware prices suddenly skyrocketing, completely defying normal growth trends? Think about it. Lately, we're seeing Apple raise prices on Macs and iPads, Microsoft bumping up the cost of the Xbox, and mobile phone makers like Xiaomi and Vivo all being forced to pass these higher costs right down to us, the consumers. For basically a decade, we've been completely spoiled. We expect more memory and faster phones for the exact same price. So, what changed?
Well, here's the reality. AI data centers are aggressively hoarding global memory capacity. Specifically, they're gobbling up high-bandwidth memory to build out their massive server infrastructures. It turns out every single advanced AI GPU out there, like NVIDIA's Blackwell chips, needs absolutely staggering amounts of bandwidth memory just to function. And the major cloud providers, they aren't just buying quarter to quarter anymore. They're locking in their supply for years in advance with long-term, multi-billion-dollar contracts. Because of this, consumer tech companies are basically stuck at the back of the line, forced to pay whatever astronomical price the memory makers demand.
With memory turning into the absolute hottest commodity in tech, let's move to Section 2 and look at how to play this SMH versus DRAM.
This right here perfectly illustrates a real tale of two bets, showing us the core differences in how investors are approaching this boom. On the left, we have the VanEck Semiconductor ETF, ticker SMH. It covers the full supply chain. It's basically the S&P 500 of chips. You get the designers, the foundries, the equipment makers, the whole shebang. But on the right, we have the Roundhill Memory ETF, ticker DRAM. This one is a hyper-focused, pure-play bet exclusively on the memory companies that are currently holding all of the pricing power.
Let's break this down a bit more in Section 3, inside the SMH ETF.
To really put the core differences into perspective, let's follow the money. If you were to drop $10,000 into SMH today, literally only $461 of that is going toward memory companies. The vast majority of your money, over $9,500, gets spread out across the rest of the semiconductor supply chain. You're getting exposure to NVIDIA's computing chips, TSMC's manufacturing, Broadcom's networking. It is a fantastic, broad, diversified bet on AI infrastructure as a whole. You're not bottlenecking yourself into just one single subsector.
Now let's flip the script and go to Section 4, inside the DRAM ETF. Launched just recently in April 2026 by Roundhill Investments, the DRAM ETF took a completely different route. It was custom-built to give investors pure-play exposure to the exact bottleneck we've been talking about. If you put that same $10,000 into the DRAM ETF, every single penny goes directly into memory companies. Zero NVIDIA, zero TSMC, zero Broadcom. It is aggressively designed to capture the pure upside of the global memory supply shortage.
And honestly, when you look under the hood, it gets even more extreme. Nearly 75% of this entire fund is dominated by just three companies. Micron at roughly 26%, Samsung at almost 25%, and SK Hynix at 24%. These three giants essentially form an oligopoly that completely controls the global high-bandwidth memory market. For the right investor, this extreme concentration isn't a bug, it's a feature. You're getting completely undiluted exposure to the three specific companies holding the ultimate pricing power in tech right now. But of course, completely different strategies yield incredibly different results. Let's head into Section 5, Performance and Hidden Risks.
Okay, the short-term numbers here, absolutely staggering.
Since April 2nd, the DRAM ETF is up an incredible 151%, more than doubling the SMH's very respectable 63% return over that exact same window. DRAM literally launched at the perfect inflection point of the memory shortage. But there is a catch here. DRAM charges an expense ratio of 0.65%, which is nearly double the 0.35% charged by SMH. On top of that, SMH is battle-tested. It has a 15-plus-year track record of surviving brutal semiconductor bear cycles, whereas DRAM is basically a newborn with a 2-month track record.
So before you rush out chasing that 151% gain, we need to talk about the fine print. The SEC prospectus dryly outlines some pretty severe risks you absolutely must understand. Because you're only holding memory companies, you are taking on extreme concentration risk. Furthermore, with Samsung and SK Hynix making up half the fund, you are heavily exposed to South Korea geopolitical risk. Any escalated tensions in that specific region could have a really severe adverse effect on the fund's assets.
And this quote right here hits the nail on the head. This is the ultimate danger of a pure-play memory bet. Memory is notoriously boom and bust. It's incredibly cyclical. When demand is hot, profits explode. But if data centers suddenly stop hoarding, or if Samsung and Micron overbuild their manufacturing capacity, prices can violently correct. We have absolutely no idea how long this specific supply shortage will last, or how aggressively memory prices might crash when supply finally catches up to AI demand.
Bringing it all together, let's wrap up with Section 6, positioning your portfolio.
So, knowing the incredible upside potential of the DRAM ETF and the frankly terrifying concentration risks we just outlined, how should you actually position your investments? Well, the good news is you don't actually have to pick just one. A really practical strategy used by a lot of investors is to pair them up. You use the battle-tested, diversified SMH as your core semiconductor foundation, maybe making up around 15% of a tech-heavy portfolio. That gives you the broad upside of AI for the next 10 to 15 years. Then, you use DRAM as a small, high-conviction satellite bet. By capping it at, say, 2 to 5% max, you get to participate in the massive memory pricing surge without totally wiping out your portfolio if that cyclical boom suddenly turns into a bust.
We've mapped out the mechanics of both the broad SMH bet and the pure-play DRAM memory bet. We've seen exactly how AI is shifting the power dynamic in the global hardware supply chain, handing pricing power straight over to a 3-company memory oligopoly. So keeping those extreme concentration risks and historic returns in mind, I want to leave you with one final question to think about. How are you going to play this AI hardware shockwave?